Okay, good morning, everybody. This is Mark Randall, and welcome to my special update on the industry here today. See, I'm getting a little bit of feedback here. Let me see if I can solve that. Okay, hopefully that solved the problem here. I have to tell you something before I even get started here today, that as I got into this research, I actually found that I was really surprised with the results of it, and I think that you're going to be here today too. You know, as we look at the last couple of years, it's been a real fascinating couple of years in long-term care insurance. Not necessarily a fun couple of years, just a fascinating couple of years. You know, we've seen a lot of players leaving the industry, starting with MetLife back in 2010. Then we watched Guardian leave, and then Unum discontinued sales at the end of 2011. We saw rate increases out there with Genworth in 2011, and then Hancock following up with one. As we watched all this stuff occur, I was kind of explaining it away using my normal thinking in the industry. Even the rate increases that were filed late in 2011, I was kind of going, you know, it's just companies making their moves out there. But in late 2011, all of a sudden the concept of rate adjustments came up. Now we were talking about companies who weren't saying necessarily that their assumptions were wrong. They were just dealing with a low interest rate return, and the American Association explained it by saying, hey, right now when we look at our product, it's a long-tailed product. We need that investment return to pay claims. Between half and two-thirds of all claims are paid by that return. We looked at the numbers there, and they said at that point in time, for every 1% decline in long-term care rates, we needed a 10 to 15% increase in premiums back to the day it was priced. We now found out that they weren't quite correct. Their actuaries now say that every 0.5% requires a 10 to 15% increase. So as we left 2011, we were looking at an industry that was in a little bit of turmoil, but nobody was majorly concerned. Then all of a sudden, in 2012, we saw some things start happening. Prudential started it. You know, they had announced rate increases in 2011 on their first two generations of products. They were the first company to take a rate adjustment. They appeared like they were a leader in the industry. All of a sudden, April, they announced they were leaving the individual market. Then July, they announced they were leaving long-term care insurance totally. Followed up with Genworth. You know, they only had 39 states with their rate increase already out. They stunned the industry when they came out and announced they were going to make significant changes to their current products and increasing prices on their older policies by 50% over 5 years. When they came out with their announcement, it was hardcore. They eliminated the lifetime, they eliminated limited pay, eliminated their preferred health, and then they dropped commission 15% in most of the states out there. When Genworth did this, they announced they had clear strategies out there why they were doing this. They were looking for products that fit their strengths, fit their profitability, and fit their risk tolerance, and they were going to maintain that through pricing actions. Bottom line is their stock had been hit a little bit, and I kind of looked at that saying what they wanted to do was get some focus back on their profitability and get their shareholders coming back. Then Mutual and United of Omaha followed up. Again, the policy changes very similar. Eliminated lifetime, eliminated limited pay. They cut commission by 15%. They tightened up their underwriting. When they came out and softened the blow a little bit, saying, hey, we think the need for long-term care insurance has never been stronger, and we're committed to being there. They hoped that they could increase commissions again in about 9 to 12 months, but they wanted to make everybody aware that was at their discretion. When we looked at their positioning, we looked at that and said, you know what? Mutual wants to be a key player out there. They want to remain strong, so the bottom line is they just have to make sure their products are strong enough to do it. Then American General announced they were walking out of long-term care. You know, when American General announced that, it was kind of funny. They had just launched their new product January 1 of 2010. Suddenly, they were walking out. They came right out and they were honest. You know what? Market conditions has meant we can't afford to be in this product line right now. Transamerica then came out, following Mutual Omaha, following Genworth, very similar moves by them. Although one thing I was surprised with them was they stopped accepting 1035 exchanges, which didn't make sense to me. And you notice they didn't cut commissions. In fact, they made a point of saying we weren't going to cut commissions. By the time all this had happened, and then John Hancock coming out and announcing their benefit builder, all of a sudden we were realizing something was really happening here. And John Hancock, when they came out with the benefit builder, I have to say, this was the first bright spot that I saw in 2012. They had put a crediting formula together to tie the inflation to their investment earnings and then give clients a chance to buy up at various ages through age 75. You know what? That was a real bright spot because that was a brilliant move on Hancock's part. New York Life, in another spot of good news, came out and said, hey, I don't know what's happening to the rest of the industry, but our sales are up. Then you have to ask, what's happening here? You know, I had a lot of agents coming to me and saying, why are companies doing this? Is this market going to be here in the future? I mean, should I as an agent continue to commit to this market? Or am I looking at a market that might not be around? That's when I started really looking into this to see what exactly was occurring. The first thing I saw was that companies aren't blowing smoke. Return on investments is by far the largest issue that companies are facing today. If we analyze this, we can go back and look at the start of this in December 2007. The housing bubble had just burst. We watched a lot of things all of a sudden coming into play. You know, it took a little while for the board to announce that we were in a recession. But basically, by the fall of 2008, we knew we were definitely in a recession, and this was affecting the entire world. Now, if you look at the academic definition of recession, it says 2 or more quarters of negative growth. And if you use that academic definition, the recession actually ended in June or July of 2009. But if you use the broad definition of ongoing economic hardship, the bottom line is we're still in a recession in the United States. In fact, in a real recent poll in the end of 2011, 50% of Americans came out and said they thought we were still in a recession, and a lot of them said we were in a depression out there. So as we watched the recession starting out there, the federal board had already been keeping interest rates low to help the banks, the corporate borrowers, and to try to get a little bit of stimulus back into the home marketplace. Basically, this whole thing started with the government wanting more Americans to own homes. Wanting more Americans to own homes, interest rates have been pushed down to allow that to happen. Now, when all of a sudden the recession came out, now we were in a whole different ballgame. The Fed's moved to a near zero policy to try to stimulate the economy. As the Fed's moved to that near zero policy, the collateral damage out there was there. No ifs, ands, or buts about it. We knew they were penalizing savers, which was going to penalize seniors, other people on fixed incomes. Chairman came right out and said, you know what, it's a trade-off. We've got to get the economy back into health again, so if we hurt these people a little bit, so be it. In fact, they even came out and tried to downplay the impact of it by saying that we were looking at only a modest portion of household assets. Actual statistics show it's closer to 17%. But this is what hurt our industry. Anytime we have a product like ours that we are making promises to pay money in the future, we're going to have a difficult time if interest rates go low, especially long-tailed contracts. When we look at long-term care insurance or long-term disability policies, anytime we're committing to pay streams of benefits over a long period of time, that environment of interest rate returns is going to definitely affect us. But it's also going to affect every policy we sell, because it's affecting government bonds, corporate bonds, and other instruments that we invest our money in. That means we're seeing a reduction of return on policy reserves, and that means that any company selling life and health was suddenly getting a little concerned about this. When we were looking at insurance, we were looking at why all of a sudden is now this becoming an issue when this started a few years back. And of course, the reason for that is because we invest in mid-term investments. Typically, our company's investing in 4 to 7 year investments, and that means that it takes time to roll our portfolios. Up until 2012, we were in the middle of rolling our portfolios. Return was still hanging up there. You'll notice if I roll a portfolio, it takes quite a bit of time before we actually see the real effects of it. So we were watching it, but you know what? We've lived through a lot of times when we've had low interest rates. Nobody was real concerned until 2012 rolled in. In 2012, everything started to fall apart. In the past year, we've watched the 10-year treasuries drop almost to 50% of what they were a year ago. In June of this year, they hit 1.47%, which is the first time in history it's ever fallen below a 1.5% return out there. If I look at the market out there right now, 2-year treasury is paying 0.263%. 30-year treasuries are only at 2.7. Money markets are 0.52. 5-year CDs, 1.41. You know, when I look at the fact that a high-grade investment bond, typically I'm looking at a 1.5% spread. I'm looking at an environment out there that when I invest my money, I'm not even getting enough return to cover the inflation that I'm guaranteed inside the contract. Now, all of a sudden, when you look at that, you are seeing some real scary thoughts out there. Understand one thing, it's not just long-term care insurance. Almost every life and health product is getting hit. In a July 3rd announcement, we saw Legal and General Senior Vice President come out and say, the current interest rate environment is the most challenging they've ever faced. And the future interest rate environment is the most uncertain that we've ever faced. They pointed out the environment right now, especially talking about the regulatory environment out there, the fiscal cliff that's coming on, and they're saying, you know what, if we want to be a player out there, we've got to make some moves. Even the business CEOs are worried out there. We look at the second quarter result from the big firms out there, and what we're seeing is most of the revenue is pretty weak. Basically, companies are sustaining profitability by cutting costs, including labor. You know, when you look at an economic environment 3 years after the recession officially has ended, we should be seeing exactly the opposite. Then we're looking at the returns they're projecting out there. If these returns turn out to be accurate at all, we're going to look at the weakest corporate profit environment that we've seen since 2009. You know what? This isn't just the insurance industry. We have complications, though, that go much farther than other industries out there. First of all, we've got statutory capital requirements that are based on models that consider interest rates. If we look at a long period of low interest rates out there, it's going to increase the statutory capital that companies are required to hold. It's going to increase the amount of assets they've got to maintain. Other factors we have to look at is we don't want interest rates to come up too fast. You know, when we're rolling a portfolio over with declining rates out there, the longer we're into that rollover, the higher our chances are of seeing disintermediation occur if interest rates pop back up. We're selling products based on rates that are linked to the current investments. If interest rates go up, all of a sudden, people start thinking, should I cash that product in? If people see rates going up too fast, they do cash them in. They look at other investments out there, and all of a sudden we could be put in a spot where our investments that we got at lower interest rates now are worth less money, and when we have to liquidate them, we're going to take losses out there. This is something that's really scary, so everybody has to be concerned that we don't watch rates go up too fast in the future. There's a lot of other financial concerns out there. We're looking at the European debt crisis over there. You know, there's been a couple of years here that we've been watching a lot of stress occurring over there. But I'll tell you what, right now, we've got a couple things happening. Spain just got bailed out, and that could see some financial panic occurring. Greece has left the Eurozone now. That could create some panicking. No matter what happens over in Europe, we got to recognize that they're headed into a recession. And a lot of our big companies are looking at Europe and the rest of the world as their business world out there. It's going to hurt them overall. A lot of insurance companies have exposure. Notably right now, Aegon out there is facing some real problems over in Europe. Same point in time, we're watching rising commodity costs. You know, low inflation caused falling costs earlier this year. Then when energy prices started to go up, it started pushing commodity prices up a little bit, but then the drought really has pushed it up. And as we look at the drought forcing up food product prices out there, we're going to see ripples across the entire economy as the commodity prices as a whole begin to rise out there. Everybody's looking at China. China has been in a slowdown for a few years now. And the problem with China is that our big companies don't just get a lot of products built over in China. We sell a lot of products to China. They've got a big growing consumer base that has contributed to a lot of growth in our companies out there. All of a sudden, we see the weak economies of Europe and the United States causing a reduced demand for their products, and that means their consumers can't afford to buy that much. This is a big hit to a lot of companies out there that have been using the Asian world as their world of increasing sales out there. Plus, the fiscal cliff is coming up. You know what? We've got a lot of things happening at the end of this year in Washington, and right now, we're looking at the two major parties out there just completely stalling each other. I mean, it's no longer a factor of what's right. It's here's what we think we should do, and here's what we think, and nobody's budging. And you know what? The CBO had to come out recently and tell Congress, if you don't do anything, we are going to see another recession here. We're going to see the economy begin to shrink again. Unemployment's going to rise. This is not going to be a good deal out there. As we watch these happen, we're also watching regulatory challenges out there. The regulatory challenges out there are major. Right now, when we look at what's occurring out there, it's kind of scary. We can actually look at regulatory as part of our problems out there. You know, back in the early days when we were getting into long-term care insurance, regulators kind of caused this mess by saying, you know what, you have to have a minimum level of premium versus claims out there. And it kind of encouraged companies to lowball the prices. Then in 2005, they reversed it, passed laws that penalized you if you took rate increases, and pushed companies to raise their rates out there. The result being that all of a sudden when we see today's environment, we're watching the regulatory and realize we got some problems. We're looking at the rate draft that's being put together in Washington right now. This is going to help actuaries figure out how do you ask for a rate increase under rate stabilization. We've got a lot of regulators sitting in those meetings saying, you know what, anything that occurs with investment rates of return shouldn't be applied to the consumer. Insurers should absolutely eat that themselves. Now, when you look at that, you look at a scary environment out there. Now, granted, there's a lot of regulators that are still sticking with the insurance industry saying, no, that's part of the moderately adverse experience out there. But the bottom line is we have to look at the draft itself and say, we have to be careful that if we take a rate increase right now, it could limit our ability to take a future rate increase out there. Then you look at California right now. California, the commissioner out there who's supposed to be looking out for the industry, apparently takes after the commissioner here in Minnesota who came out bluntly in a speech and said, I wish there was a world with no insurance agents. The commissioner out there is strongly committed to a bill that's going to definitely limit our ability to take increases in California because they're saying, you know what, a change in investment yields might not be a good enough reason to take a rate increase at all. Then we're watching some interstate regulation commission that's coming out and saying, you know what, we think the insurance industry and long-term care insurance should true up their rates all the time. In fact, if they don't true up their rates regularly, we're going to ban them from selling insurance. If you were a president of a company and you were looking at all this happening out there, you'd be a little spooked, especially when you see the number of regulatory hearings on rate increases in long-term care that have occurred in the last couple of years out there. So when we look at the future of regulatory out there, we're looking at the fact that long-term care insurance is a unique contract. It should be considered health insurance. But due to the sales practices in the past and the fact that the majority of our policyholders are seniors out there, a lot of people want to limit our ability to take rate increases, which undermines the entire concept of guaranteed renewability. So we're looking at the future in the regulatory world of saying, could there be the potential that we could see legislation passed that would say we're not allowed to take rate increases in long-term care insurance? You know what? When you look at all this and you recognize a couple other disturbing things that are occurring out there, you can see why everybody's running a little bit spooked right now. You know, the potential trends that we're seeing out there are scary. Milliman's coming out there with studies right now showing that their studies indicate that anytime we have a long duration, anytime we have a limited pay or a lifetime benefit plan, we're not only seeing a touch more claims, our claims are definitely of longer duration. Now, I'll tell you what's interesting is we've actually got two groups studying this right now, and they're disagreeing why they think this is occurring. But you know what? You're looking at the trend and you're realizing there's something there. Overall, studies suggest that claims are increasing. You know, there's a lot of interesting things on this, but it could be simply the fact that today's baby boomers aren't as healthy as the generation in the past. We're looking at a generation of people that are overweight, they have more chronic conditions, and the result could be that we could see an upspike in the claims out there. Then you're looking at studies out there that are questioning life expectancy. You know, there's one study out there today that says we might have seen the peak of life expectancy occurring right now. That, in fact, in the future, we're going to see life expectancy begin to decrease again. Again, the reason being due to the poor health of the current generation of baby boomers. They're questioning improving morbidity, a factor we've always assumed in long-term care insurance, that we're going to see a 1.5% improvement in morbidity on an annual basis out there. All of a sudden, people are wondering, are we going to see that improvement? All of this just solidifies the fact that, you know what, whether we like it or not, we're still shooting at a moving target out there. We've got a group of people out here that are seeing a lot of changes in what their health is. We're seeing life expectancy moving around. We don't know for sure what the future is going to hold. Then on top of all that, we're seeing negative press. Who wants to be involved in an industry that all of a sudden you got articles coming out saying, do insurers even want to sell long-term care insurance? You know, consumers out there saying, are you going to be here tomorrow? You know, you have to ask yourself sometimes, do you read the article or the headline? Because this article, should you purchase long-term care insurance, actually was a very positive article for our industry. But I'll tell you what, it certainly didn't start out that way, and the headline certainly didn't show it that way. We've got consumer groups out there saying, you know what, the insurance industry is ripping us off. We should make all the filings public from now on. So the press isn't helping the whole situation. When you look at everything that's happening out there, everything that's occurring, the first thing we have to look at is, what is the bottom line out there? If I look at the bottom line on return, it says, you know what, we've had a long period of low interest rate returns, and the forecast says that this is going to continue for a long time. Whether we like it or not, we've entered a significant price and benefit adjustment cycle. This isn't good news for us as agents or for the consumers that are going to buy these products out there. But you know what? The continued low interest rate environment is forcing these moves. Carriers can't stand pat. They have to make moves out here. And their options are real simple. Do I increase my cost? Do I decrease my benefits? Or do I get out of the market? You have to have a delicate balance if you're going to stay in the market, because you have to have producers selling your products. So you have to make sure you have attractive enough products for the producers. You have to make sure your pricing is in line with the other companies. Otherwise, you're not going to have an acceptable product to the consumers out there. So when we look at return, we have to realize that it's got a big effect on what's going on right now. Is it going to last? You know, that's the million-dollar question right there. If anybody could tell that, we'd know. But the fact is, right now, we've got economists coming out there saying we should expect 2 to 3% returns for the next 10 years out there. And you know what? This isn't just regular economists. Even Warren Buffett came out and said, I think we should expect lower returns for the future, putting no time limit on it at all. He said, we're going to see returns of under 5% happening out there, and we have to learn to live with it. Could it get worse? Yeah. Take a look at this article, August 9, 2012. So we're looking at something that's real recently here. In this article, they're talking about a new kind of bonds that are being sold over in Europe right now. And these bonds are neat bonds because you buy a bond for $100, and it promises you that it will pay you back $97 3 years from now. In other words, you're actually investing money to get a negative return. And there's a lot of people saying that they should bring this over to the United States because that'll help stimulate the economy again. Could you imagine a situation out there where all of a sudden we were investing in negative returns and thinking that a lower negative return is a good deal? You know what? That's scary, because if that occurs, the insurance industry is out of business. We make our living on the fact that we can get a return on our money. If we all of a sudden can't get a return on our money, I don't know that we'd have a product left that we could sell out there. A lot of people say, well, Mark, it can't last forever. And I say, you know what? Can you guarantee that? But the fact is, you're right. It won't last forever. But what the top insurance executives are asking themselves right now is, will it get worse? If it does, how much worse is it going to get? How long is it going to last? How do I deal with this? Think about this in the back of your mind. If you're the president of a big insurance company out there, they've been in business over 100 years. They're worth billions or hundreds of billions of dollars. At this point in time, a lot of those presidents and vice presidents and top people in the entire company are sitting there going, please, God, don't let anything bad happen while I'm at the helm. You know what? I don't want to be the person that goes down in history as bringing Prudential into bankruptcy. It doesn't matter whether your company's $1 million company or $1 billion or $100 billion. The fact of the matter is, you look at everything I just talked about and you're saying, we're in the weirdest environment we've ever been in. And we have to remember, insurance executives aren't risk takers. They're risk managers. When I first started selling or teaching insurance, I used to tell agents, remember one thing about insurance? We're honest. We go out to people and tell them right up front, we're not always going to give you the best return on your money, but we'll guarantee you two things. Number one, you will get a return. And number two, you won't lose your money. And you know what? If you want to lose your money, go talk to a broker, okay? Because I'll tell you what, you talk to financial planners out there, they do God's work, okay? You came into this world with nothing, and they're trying to make sure you leave with nothing too. No, I'm just kidding you out there. Fact is, though, is the point I was trying to make is that the insurance industry doesn't take a lot of risk out there. We're the companies that are safe. We're the companies that will make sure you get your money back. So if we look at this reduced return out there, let me show you what this really means to an insurance company. If I'm looking at a 40-year-old person in long-term care insurance, and I'm charging a $1,000 premium per year, and I'm pricing my product based at 6%, I'm estimating the need for a claim at about 45 years. If I look down there at the future value, these are calculators come from the CEO, by the way, I'm looking at a $212,000 number. Now, if all of a sudden my return goes down 1%, how much do I have to collect to make up that same amount of money? I'm at $1,332 a year. I need a 33% rate increase just to stay equal with what I had before. If I go all the way up to a 60-year-old and I run the same numbers, you'll notice I'm looking at a 15% rate increase just to make that occur. And we're looking at 1%. Today, most of the companies out there are actually looking at a 3% difference. Take a look at 3% on a 40-year-old. If I'm collecting $1,000 a year at 6%, I build up that 212. Now all of a sudden at 3%, I'm going to collect $92,000. That's a lot of difference out there. If I want to look at how to increase that rate to make sure I can get the same amount of money, I'm looking at over 100% rate increase that I'd have to take on that client. Even if I move up to a 55-year-old age that reflects our industry better, I'm still looking at over a 60% rate increase here. Now, when I'm looking at over a 60% rate increase, that's scary. And that's new premium only. Remember one thing, anything I've got in force already, I'm going to have to get a higher rate on that. So when I look at this, I'm seeing a real scary environment. Here's an actual example. This comes directly from American Financial's filings out there in 2010, 2011, 2012. They stopped selling long-term care insurance in January 2010. They had 60,000 policies on the books. At the end of 2011, they're sitting there with $490 million in reserves, approximately $8,200 per policy. Right then, they estimated that if they look at the value of their reserves and the present value of all their future premiums, and then look at claim costs, expenses, they're looking at a profit of $25 million. As long as they can get rate increases, if they have any type of adverse experience, they're okay. Their concern is, can they get those rate increases? And are they going to continue getting a return on their investments? Look at the bottom line numbers there. For every 1% change in assumptions for claims or 0.1% investment yield, that's going to bring that excess value down by $10 million. Now, if I take a look at those numbers, I'm saying, okay, right now then, we get a book of business that's profitable. But if I look at a 0.3 investment yield change, it's going to put it into the negative. If my investment return drops 1%, I'm going to be facing a $75 million loss. If regulators suddenly tell me I can't take a rate increase because of investment rates of return, I got real problems here. Ask yourself right now, if this company came to you and said, I'll give you this block of business, you just take it over, no charge, would you buy it? You know, I have to look at these numbers and say, if I'm looking at the fact that 0.1 change in investment yield is going to chunk this $10 million, and I only got $25 million to play with here, that might be a tough bet. Let me ask you a question. If you were making decisions on this block, what would you do right now? This is the environment companies walked into in 2012. If I look at a case study and say, let's assume we're looking at a current company in our business, and let's use the same numbers that we had here in estimates from this previous case. And then I said, what are my options as a company? What should I do in long-term care insurance? Should I stay in the market or shouldn't I? Should I continue selling? Should I go after business? What should I do about my pricing? You know, each of these holds some real interesting potentials. And I'm going to tell you right up front, there's not going to be as many notes in this area as I have in the other areas, and that's mainly because of legal reasons there. The first question I have to ask myself is, should I stay in the market at all? Actually, this is a pretty easy question for most companies because in the current situation out there, we don't have a good selling environment. The chance of finding a buyer that's going to pay you enough money is going to be real slim. So most of our companies aren't going to have any choice. They're staying in the market. Whether they actively sell or not is irrelevant. They're going to be in the market for sure. Then the question is, should we keep selling? And I want to tell this right up front. Everybody knows me. I don't pull any punches here. And I'm going to name company names, okay? If by any chance you're a home office attendee and I accidentally misstate the position your company has taken, do me a favor and send me an email with the correct information. I'll be happy to change my speech. Otherwise, I apologize. I don't want to offend anybody, but I'm just going to call it like I see it. That's the way I've always done this kind of type of stuff. Question is, should we keep selling in today's market? Understanding a couple very important points. If I continue selling, my portfolio return is going to drop faster. As I watch my portfolio roll, I'm going to see my overall rate drop a lot quicker if I'm bringing in new money than if I just stop. Number two, in long-term care insurance, we have an interesting product because of the cash flow. If I don't do anything and I'm increasing sales at a rate of about 10% per year, a typical company is going to see about 11-year break-even point in cash flow. If I turn around and I stop selling anytime after the fourth year, I could see a positive cash flow occurring within 2 to 3 years maximum, possibly even less than a couple of years. So these are points I have to keep in mind when I'm looking overall at what should I do here. There are companies out there that are going to say, yes, we want to keep selling. Why? Well, the first group of these companies are going to be companies that are saying, we want to be a market leader in long-term care insurance. The bottom line is, as we know, there's not a big group of agents out there that sell long-term care insurance. It's a very small group of agents nationwide. They need product. We can't just back out of the market right now and leave them sitting with nothing. So the fact of the matter is we're going to go ahead. We're going to continue in the market. We're going to have to make some major moves in our product. But the fact is, we think they'll understand, and we think that they'll remember us when the market gets good again and other companies come jumping back in. Who's playing this game out there? I think right now there's 3 major companies. Genworth, of course, Mutual Omaha, United Omaha, and Hancock. Those are the three companies saying, you know what, we don't care, we're sticking in the market. Then you got companies out there going, you know what, we don't really have a choice, okay? That's MedAmerica out there, okay? MedAmerica's sitting there going, we were a company started for long-term care insurance. The bottom line is we really don't have a choice of saying, should we drop this product line or not? We're stuck. Transamerica is another company playing that game. They already bailed out of the market once. They don't dare bail out of the market again because they know every agent in the world will take a look at them and say, we don't trust you at all anymore. So they don't have a choice. They're sticking in the market. Then you got other companies that are going, let's take advantage of this situation. You know, we weren't anybody before, but this is our chance of doing what Jackson National did back in the days when we saw the big shakeup in life insurance. And that's, of course, LTCi. Okay? They're out there going, this is a chance for us to stick around and see what occurs here. And then, of course, you got companies that are going, why not? You know, you got New York Life out there, Northwestern going, why not? Okay. The bottom line is that we were priced right in the first place. We're making a profit on our policies. Of course, we're going to stick around. You could include in that bracket State Farm. State Farm's going, why not? Because they're going, I don't really care what's happening in the investment rate of return. We want a product for our agents to sell, and so we're staying in the market. So there's a lot of good reasons for companies to say, yes, we're going to stick around the market. Vice versa, there's a lot of good reasons for companies to say no. You know, why should companies say no? Well, first of all, you got the companies that are saying, why not? You know, that's Guardian, that's AIG out there. They're sitting out there going, we didn't have a big enough market share to be a player anyway, and we weren't getting a big market share. Might as well bail at this point in time. Interesting, though, is the companies that are playing on their size. This is Prudential. This is MetLife. They're sitting there going, you know what? We're such a big company. The fact is who cares if we pull out right now? If we pull out right now, wait for this market to settle down, then we jump back in, agents are going to sell for us. They're going to want to sell safety, and we're big, you know, Prudential, $624 billion. They're big. So these are companies that are saying it doesn't matter if we pull out or stay in, we're not going to affect our market share. Both Met and Prudential are big in the group and the workplace. And the fact is both of them can afford to say, you know what, let's wait for that market to mature a little bit anyway. Let's bail now. We'll come back in and we'll still be a dominant player. Then, of course, you got companies out there going, should I enter the market? And, of course, if anybody comes to you and asks if they should enter the market, just ask them if they need their head examined, okay? Bottom line is I don't think we're going to see any companies going, lad, let's jump in the long-term care market today. They're going to kind of sit back and say, let's wait and see what's going on out there, okay? We don't need to get in a market that we have no clue what's going on and that things are so shaky. So let's concentrate on companies that are saying yes. And then let's take a look at the pricing. Regardless if I'm going to stay in the market or not, I got to worry about my old book of business. So pricing is going to be a factor for a lot of companies out here. If they look at the current economic climate out there, they've got current investments that aren't even keeping up with inflation. They're watching the gap between assumptions and actual return growing as their portfolio is rolling over. And they're seeing no end in sight. You know, even the most optimistic people are saying this is going to last 5 years plus. Most economists are saying 10 years. If I wanted to be very safe and I wanted to assume that we were looking at a lower interest rate environment for the entire policy length, I would look at my book of business and say, I need a 60% increase over everything I've done up to this point in time. Then I have to look at regulatory issues. If I look at regulatory issues, I know that regulatory environment out there says that the older books of business out there are going to be a book of business that we're not going to be too concerned about. We're going to give them a little bit more flexibility out there. Newer books of business are going to come under a lot more oversight. Our best case scenario in rate increases out there is that we're going to see a lot of increased oversight. Worst case scenario is we're going to watch the number of states that are severely limiting increases grow out there. My safest bet, if I was advising the president of an insurance company today, would say, gamble on the fact that you're not going to be able to see any rate increases in the future or very limited. If you want to do something, do it right now. Look at rate stabilization. Be aware of the fact that if I take too big of a rate increase and I can't put an 85% loss ratio on that, I got to refund all that premium, which is going to create major problems. So not only should I concentrate on my current books, but I got to figure the fact I can't rely on rate increases alone. I got to figure out other ways to save money here to make sure I can stabilize this book of business for the future. If I take all that into account and I look at the smartest strategy, I would sit back and I would say, okay, first of all, let's get a new product out there as soon as we can. And let's price that product up strong enough that we think we'll never need a rate increase on that book. If we don't already have a product in the works, tell you what, you team over there, you get started on this and get it moving. Now, old books of business that we got, let's start filing rate increases as fast as we can. But let's ease into them, okay? Because we think we're going to get a little bit easier treatment there. Let's go in there, ease in, we'll step these things in. Don't assume that we're going to see any heavy lapses, even if we start taking some major increases, because everything's showing up to date here that we're going to hit about 5%. But let's get as much as an increase as we can on these as fast as we can. Let's shoot for a 15% return, and then let's hope we get some return. If I look at current product, okay, here's the deal. We can't rely on rate increases here or ratings totally because we got that 85% rule to look at. So we got good evidence on some of these benefits that they're going to create problems. Let's get rid of them, okay? Lifetime benefit, let's get rid of limited pays, etc. Let's adjust our pricing going forward to strengthen that book enough that we think we can hit a moderately good projection out there. But since we know that won't be sufficient if we hit a long period of low return, let's cover that by tightening the underwriting as fast as we can and cut commissions, and just cut those commissions and wait until the return comes up before we give it back to the agents. By cutting commissions, now we're not having to worry about that 85% rule. Forget about the media, forget about agent concerns. You know what? It'll be a lot worse if we can't back up our promises at all. If we end up like Penn Treaty sitting out there, they'll be a lot more upset with us. And as I looked at this entire strategy, I thought to myself, does this sound familiar? You know, I have to tell you, this is not what I expected to find. As I started into this real deep research, talking to people at the home offices, I was buying into greed. Okay, I was thinking that companies were taking advantage of this market to get higher profits out there. Let's face it, Genworth even came out as much as said so, you know. I thought companies were taking advantage of other companies' movements. That's what I was thinking was happening with Mutual and Tranny, is they were watching Genworth going, okay, as long as they did this, let's jump on board. What I didn't realize was the extent of the potential problem we were seeing with return on the industry as a whole. I didn't realize that when we're looking at the potential of negative returns, you know what, that'd destroy our industry. If we see a long period of low returns, it's going to dramatically affect the future of our industry, and it might even eliminate long-tail contracts out there. When I look at the companies and their positioning they were taking this year, they should have been scared. They had to react, and they had to react strong. And you know what? Actually, as I was finalizing writing this, I was saying, not only was this not what I expected to find, but it was stunning to see the extent that some of these companies hit exactly what I found on the nose, okay? They were making the moves that were the smartest moves I think they could have taken based on the environment that they're facing out there. The good news is that in my mind, companies like Genworth, Mutual of Omaha, John Hancock even, I got to give Hancock credit because they made big moves in the pricing a couple of years ago. They've shown that they're willing and capable of making the moves they need to stay strong. If the return comes back within 5 to 10 years, a good positive of that is we may have adjusted premiums enough that we truly will see rate stability in the future. And that's a biggie since clients out there are really concerned with this. The current moves that we're making by increasing the pricing out there, limiting some of these benefits that we know are causing problems, is actually going to make the return in this product more attractive And as things start to get better out here, it's going to encourage more companies to enter long-term care insurance. Because you know what? The need out there is real. Long-term care insurance is real. The market's going to continue. And the good news is we have companies that are showing us they're committed to long-term care insurance. And we're already seeing new concepts and new products coming out that are going to help solve the problems. You know, Hancock with that new inflation rider. What a brilliant stroke out there. What should we do as an agent right now? You know, I'm going to give you some opinion right now, and I hope you don't mind. Right now, I take a real hard look at your current carrier. What did your carrier do as we watch this environment occur? What are they doing right now? Are they making the right moves to protect themselves? I don't want to tie myself to a carrier that all of a sudden I'm going to see big problems in the future. I'd rather have a carrier that's making the moves to protect themselves and make sure that we are going to have a strong product in the future. Don't make excuses for the higher prices right now. Every study we're seeing right now tells us that the consumers are concerned with two things. That they might buy this product and you price it up and end up to the point they can't afford it, or that you're not going to be there when they need you. That's their two biggest concerns. Over 50% of consumers right now are saying, solve these two concerns and I'm willing to buy from you. So that means that in my mind, most clients are willing to pay a higher price right now if it avoids future increases out there. If I walk in and explain what's going on, and I say, here's the good news, and that is, if when the return comes back, if it comes back in any time within the next 10 to 15 years, we're going to be in great shape for the future. So I know that this can be a positive. I don't want to make excuses. I might want to make excuses for a company that's not making moves. But I also am going to take a hard look at my companies as a whole. You know, some companies that we're writing with are maybe just too small to be in this environment out there. If I'm looking at a company out there that doesn't have a real sufficiently good asset base out there, I might be questioning whether I should be working with that company or not. And no matter what in the back of my mind, I have to think that higher prices are going to affect sales. You know, I'm not somebody that sticks my head in the sand, and I'm not somebody that just glorifies things. If I'm going out there with a higher priced product, there are going to be clients that aren't going to be able to afford that product. So that means I got to work smarter to offset that. And I have to tell you something. I can't believe that our timing ended up so perfectly in this area. But if I could, let me give you a little sales pitch to help you figure out a way to work smarter. You know, critical care, as we introduced it this spring, we introduced it for one problem, and that is underwriting. Now that we're seeing companies making moves to toughen up that underwriting, it means you're going to walk into more people that you can't even write an app on, or more people that you're going to send in apps on, and they're going to get declined. I have to tell you something. Don't walk away from that business. The way to turn your declines into gold is use critical care. I'm sorry, I know we're the company that is bringing this product out to you, but I have to tell you something. I wouldn't care who was bringing this product out to you. I'd be telling you the same thing right now. It is the best alternative to long-term care insurance available in the industry. If I have a client that I can't get a long-term care policy for, I can't imagine a better alternative than putting them with critical care. My studies have shown that in a normal client situation, it's going to pay more claims than a long-term care insurance policy is going to pay. I could actually even see agents that are going to start selling this in lieu of long-term care insurance. I wouldn't suggest that, of course. I believe in long-term care insurance. But as an alternative for your clients who can't get it, there's nothing better. It's a 5-question application. Issue time, on average, 3 days. And they're issuing 98% of the long-term care declines out there. It's easy to explain, and it's easy to sell. That's the only selling pitch I'm going to really give you today, because I'm just going to say, if you're in long-term care insurance today and you're at all a serious producer, you have to have critical care in your portfolio. If you don't, pick up the phone and call 1-800-842-7799 and ask for your regional director and get your contract and start it today. Because you don't want to be out in the field in the future here without critical care in your portfolio. I want to thank everybody very much for attending today's webinar. I'm sorry I got a little bit long. I wasn't supposed to go over a half an hour, but I guess I didn't do too bad in that. I want to tell you that I appreciate all of you for taking time out of your schedule and attending today. If you want, I would invite you to join me in the upcoming webinars. I'm doing a repeat of this webinar on Tuesday at 11 a.m. And then Wednesday, September 5th, I've got internet selling out there. Thursday, September 6th, I have critical care. Internet selling is an introduction to help you get into the world of internet selling out there. Find yourself selling a lot more efficiently. Critical care is an in-depth session where I'm going to talk about how to sell the critical care product. You can register for either of these at www.goldencareagent.com. If you'd like a copy of today's slides, send an email to info@goldencareusa.com. We'll be happy to send you out a copy. I know that I would normally open it for questions at this point in time, and I may try to do that, but I'm going to tell everybody up front if we get too much background sound because we got so many people on today that I might have to cut that off. So I do want to tell you before I do, thank you again for attending this. I do appreciate it.